Hi, everybody. Thanks, Dave. My name is Jeffrey, and I'm the founder of Power E-mini Trading. And with my partner, Bill, and we run a E-mini day trading system, basically, that I'll talk about at the end. But today's topic, let me talk a little bit about myself. I have been a software engineer, programmer most of my adult career. And a while back, over a decade ago, I basically dedicated myself to designing trading systems, both for stocks and for intraday day trading of the futures market. So today I'm going to talk about breakout trading. When we use the word breakout, typically a lot of people have a negative connotation with breakout entries. And the number one reaction to breakout trading is, oh yeah, they have a high failure rate, and most breakouts fail and don't follow through. So what we're going to do today is I'm going to go through and talk about the different types of trade entries, breakouts, pullbacks, and counter trend entries, and compare all three of them with each other, and talk about the advantages and disadvantages. And we're going to talk about why not every breakout is created equal. And then we're going to look at something that I developed, which I call the dynamic trigger range. And finally, we'll talk about my automated alert software. So to get started, let's talk about the different types of markets that we face. Now, just as a little premise here, we're talking about intraday trading of the futures market, and that can be the ES or the S&P 500. We've got other symbols like the NQ, the YM. There's oil, CL, gold, and so on and so forth. And what I'm going to talk about today is applicable to any of the futures symbols. And we're basically talking about day trading entries that you take and then you exit within the same day. Now, let's just talk about the types of markets that typically we experience as traders, and we'll talk about why that leads to complication for traders. The first type of market you're going to see is a cyclical market. And so imagine you're going to use the opening price line as kind of our baseline to work off for the day. We get price opening, the equity market open, and the behavior we see on a cyclical market is big wavy type price action. Now this is where your moving average crossovers and all that kind of stuff and your overbought and oversold work great because they catch the reversals at the big wide swings. Okay, so guess what? A cyclical market could be a real easy market to trade just because of the really nice smooth and wide types of setups that they provide for us. And your classic setup that you see in marketing usually has a big, we caught it here at the bottom and rode it up to the top thing. That's great. That works easy in a cyclical market. There's no big science involved in that. The other kind of market that we will experience is a real spiky market. This is where we get a lot of indecision, and the market might be trapped where it's in between barriers, and so the buyers try to run price higher, they get stopped, they get knocked down, and they sell down to an area of support, and so it goes back and forth, back and forth. There's no true commitment for the day, and we could look at price in retrospect, and it's just kind of aimless behavior. Now, this kind of a market, again, it can be traded, but we're not going to have the big wide swings and the wide setups. So this is where, let's say, like a typical moving average crossover might get tripped up. You get the whipsaw, and you get caught up in a lot of this minutia where price gets tangled up on the open. As a matter of fact, we had a day like this today early on where we in the futures market where we were pegged to the open and spent most of the day stuck on the open, only to break out a little bit later. The third kind of market is a stair-stepping market. Now this is a market that you typically see this trending day. So a good example would be, let's see, was it Friday? Friday we had kind of a stair-stepping market. Monday we had a stair-stepping market, and this is intraday. So what that means is, and I've got the mirror image on both. Obviously, we'd either be going long or short. So we've got price. Again, we're pegging off the open, and you typically see price will make a move to a higher level. It pulls back or consolidates and kind of gets into congestion, and then it breaks out to a new level. So we get this stair-stepping action all day long, and it ends up looking like a move up an escalator. Your chart starts over on the left-hand bottom corner and ends up in the right, or vice versa, down at the right-hand bottom corner. And so this is typically a market that's under accumulation, right? All day long, there's heavy buying pressure, 5, 8 times the selling pressure, and so we just float higher and higher. And this is a stair-stepping market where, again, the sellers are going to be overwhelming the buyers just all day long. Every time the buyers try to get a foothold and hold the price, they get broken down again. So one of the challenges to any day trader is that the market is always going to be flipping in between one of these three types of main styles: the big wavy market, the spiky market, or a stair-stepping market. Now, this type of a market is where we typically see the long range days. Like if you looked at the daily price bar at the end, that's where you're going to see the low maybe down at the the bottom of the bar, and it finishes up in the upper 5% of the top of the bar at the very end of the day, and that's your big long range day. So each one of these markets, different types of setups, different types of strategies, and different types of systems will work better in different types of markets. And obviously your price targets, if you think about it, in a stair-stepping market, if you get in early long here and we're going to be under accumulation all day and you just hang on towards the close, you're going to catch the entire big run, right? That doesn't work so great when you're in a spiky market, because you could be stopped out. And so the main point I'm trying to make here is that as an intraday futures trader, and this all holds true if you're looking at equities or the ETFs as well, intraday, we've got these three kinds of styles of markets to deal with. All right, now let's talk about the typical methodologies for taking trade entries. There's three of them, but let's first talk about the way the markets move. And when we talk about these basic types of patterns that I'm going to be showing you, these occur on all levels. We could see these on a 60-minute time frame. We could see these on a 10-second time frame. We could see these on range bars or tick chart bars. It's all going to be relative to the time frame that you're looking at, but you're going to see the same type of price behavior. And so what we typically see in momentum movement, when price has directional bias, in other words, there's commitment to move price in a certain direction, we're going to see this type of behavior. The momentum is pointing, and we're going to use a long example here. Momentum is pointing to the upside, and price overshoots, and typically overshoots to a level, or maybe it's hit some previous resistance, or it's just overshot a little bit on the buying pressure, and that's where you see your stochastics and RSIs and all that overbought, and then price will pull back gradually. There's profit taking that goes on, and there's selling, shorting that goes on, and so price gets driven back, and it gets driven back into the bigger wave of momentum, okay, to the upside in this example. So we're going to talk about the different ways that intraday traders trade this basic kind of movement. So what we're looking for is we're looking for price to pull back and then continue in the direction of the main momentum that we see price in, okay? Now here's your typical pullback entry. A pullback entry basically says, okay, price is making this move to a certain extent, which is is our like alarm bell. It's our wake up call saying, hey, there's some energy in the market. Now let's wait for price to pull back to where we conceive that there is maybe some support areas, and price is likely to bounce and kind of slingshot back in that direction. Okay, so far so good. A counter trend trade basically says, okay, we see price make this move, it's overshot, and maybe it's hitting resistance. We're expecting it to go ahead and pull back towards the mean, right? And so we're going to go ahead and, in this example, we would short, looking for price to pull back into the main support level of the momentum. All right. A breakout entry basically says, okay, here's the initial price move that's showing that we got some energy. Here's where they stopped it, right? So there's like the line in the sand. And in order to make this move here, there was a lot of buying pressure, a lot of maybe trading that transpired in this range here. But now price has fallen back and it's stuck in the congestion of this range. So what we're going to do is we're going to wait for price to get above this level, which was the last known line in the sand that stopped price. We're going to wait for price to get above that level and break out and make a move, and we're going to try to exploit that. Okay, so we've got, we can basically break it down to 3 types of technical trade entries. Now, there's other things that can be done. Things can be averaged around and added to and taken away from in your positions. But just in general, these are the 3 basic types of mechanical technical entries that traders use. All right. So the question would be like, okay, well, which one's better than the other? And I mentioned early on that breakouts get kind of a bad rap. As a matter of fact, I used to shy away from breakout entries as well, because they just, I always heard, yeah, they just don't work out. Most of them fail. And so it turns out that, let's go ahead and analyze each one of these now. So here's our breakout entry. And basically, when we take our entry based on this kind of a concept, we're going to have one of 3 outcomes, one of 3 scenarios. Either the breakout's going to work and take off in our favor, either it's going to fail on us, fizzle, come back down and reverse and come back down and hit our stop, or we're going to wiggle around, maybe we just scratch the trade, break even. Okay, fair enough. 3 outcomes on the breakout entry. All right, so let's take a look at the pullback entry. So here's our concept where price surges, pulls back to our area of support where we're expecting a bounce now, right? And we could take our entry, and here's our 3 scenarios. Either the trade works, goes back in our direction, either goes back up to this area of resistance and stops there, or it continues on, right? Trend continuation. Or we get a failure. Guess what? We get hooked into a little trigger on the bounce, but guess what? It doesn't bounce. It was a false bounce. And so we end up continuing to break down, and we run down and hit our stop. And of course, we could bounce around, clang around, and just scratch the trade and be out, break even. So there's your pullback entry. Guess what? It's got a failure as well. And here's your counter momentum entry. This is where you're trying to maybe short against a big rapid surge in the market. Well, guess what? You could be right as rain. Here's the resistance, and price runs up to that exact level, and then basically it's going to revert back to your main momentum, back to support here, and you can play this short, right? So you can have a winner. However, price could feign that it's going to start to pull back and trigger you into an entry. And then, of course, we could end up with the infamous short squeeze right here, where there's so many traders shorting that when the trade does not begin to pull back like everybody's anticipating, everybody bells and they're buying to cover, which creates buying pressure, which pops the price against you. And then of course we always have the option of if we're clanging around back and forth too long, we can scratch a trade and get out break even. So what I've shown you is that all three of the types of entries have the same exact type of failure problem, right? The breakout can fail to break out and fizzle and come back down and hit your stop. The pullback can fail to bounce and just continue to pull back against your stop. And the counter trend move can fail to pull back and revert back to the mean and keep on a trucking, and then you're stopped out. So guess what? In my analysis, in my development of trading systems over the last decade, and I've developed several dozen types of different entry techniques and strategies based on every one of these types of entries. They're all valid types of entries. And guess what? I've got my algos on all of these down to around the same failure rate, okay? Which means we can achieve the same win rate and the same failure rate with all of these types of entries. So basically, the moral of this story is that in reality, there isn't one better than the other. They're just different flavors of taking entries and playing the markets. And so a trader should not have any negative connotations with breakouts. They perform equally to pullbacks, equally to counter trend. Same win rate, same failure rate. We can achieve those same levels. All right, now that being said, let's go back and talk about the trending market. With a breakout entry, and there's pros and cons, so let's talk a little bit about the pros and cons. Let's start in reverse and talk about the negative with the counter momentum entry. You know, I used to be, when I was heavily into day trading stocks, and when I first started trading the futures market, I was like an expert at shorting against the big moves. That's what I like cut my teeth on, and that's what I was really into. And the concept of counter momentum entries, again, they're completely valid. The trades can work. You have trade triggers, you have trade failures, and it's just another trade, right? The main argument against a counter trend momentum is it can get you focused against a trending market. And so what happens is every time the market makes a move, you're trying to counter it, but it keeps moving higher, and you're trying to counter it again, and it keeps moving higher, and you're trying to counter it again. So you can find yourself fighting a trending market all day long. And so I've had days where I took, 10 trades trying to short the market, really, perfectly, and basically either ended up at a loss or break even when all I had to do was buy a contract here and sit on it all day. I would have made a small fortune, you see. So that's one of the traps of counter trend trading. Not that it's not valid, because there's times where you can mix and match. You can play long moves, and then when you reach a point where you really think the market's going to hit an area of heavy resistance, like today, for example, the market ran up a couple times to the previous day's high, yesterday's high, and that's where it hit a brick wall and turned and reverted back to the mean. That was an obvious place to do a counter trend. Now, one of the nice things about, well, let's talk about one of the negatives with pullbacks. Now, pullbacks, like I mentioned, they have the same kind of a failure issue where, yeah, you get a nice pullback and you're expecting a bounce based on Fibonacci's, based on support, based on moving averages, but it don't bounce. It keeps on, you get triggered into a fake bounce, but it keeps on a truck and your stop gets hit, right? One other negative to pullback entries is this. In a super strongly trending market, sometimes the market don't pull back. In other words, the market will take off intraday, let's say off of our opening price line here, and not ever pull back to trigger one of your pullback setups. That's entirely possible. You can sit there and watch price sail away all day long, and it just never triggers one of your pullback setups. Okay. So besides a pullback just failing and not bouncing, you might not even get a trigger in a market that's too strong. Now, a breakout is guaranteed to catch a super strong market. And that's one of the big positives of breakout trading, because think of the concept of your breakout levels as like kind of a net that's stuck over the session. In order for price to continue to advance, so let's say in retrospect, we end up with a super strong trending day, guaranteed breakouts caught those moves, because by its very nature, price had to move to new levels throughout the session, thereby breaking out. So breakouts, breakout types of entries do have this one kind of advantage. Now, one of the things that I have developed and focused on with my types of trading strategies is a concept of I call it barrier trading. With the concept of breakouts, we're not looking at the breakout price as like where we want to get in. We're looking at the breakout levels as a barrier for entry. So the way to think about it is the market's like in constant battle all the time. And one of the issues we have with breakouts is when price makes a move across the breakout line, do we want to be first in the line, the charge, or do we want to be back here in the reinforcements maybe, right? We run into a dilemma. If we're too close up front and we get across the line too quickly, we could, run right into danger and be in too early, basically. However, if we're too far back, in other words, maybe waiting for too much confirmation, we can miss a move that takes off extremely rapidly. So there's always a double-edged sword there. The concept of breakouts is this, that when price makes a surge, like showing it's got energy, and then attempts to revert back to the mean and pull back, we're pulling back into levels of congestion. So it's almost like, you're a guy on the street and you're surrounded by a bunch of thugs, right? You're in congestion. The concept of breakouts is that price is able to break away from that congestion, and once it gets across the line, it goes into the free and the clear, right? And so price is able to make bigger moves because it's no longer in congestion. Now, real quickly here, because I'm running out of time, some scalp targets for the ES, real basic scalp targets are, we use 3 ticks as a real quick, what I call a delta target, where we can cut our position in half. These are easy wins. We can catch an entry and usually hit that target. There's a 1.5 and there's 4 points. These are moves that the ES futures makes many times per day, and it's a matter of just catching those. We can get away with very tight stops, 1.5 to 2 points. The NQ, for example, we go out, 3 points is our delta target. That's an easy win. And then 5 points and 10 points are more substantial types of moves. On the NQ, we would use a -4 point stop. Now, these are just a couple basic configurations just to give you an idea of what some of your targets could be. In our online help, we've got all kinds of different configurations that you can play. Real quickly, this concept is basically that integral to my strategy is what I call the dynamic trigger range. And this is something that my system computes all day long. Basically, computing a range, we know the high, we know the low, and then all throughout the day, we're looking for price to break out. And one of the things you'll learn is 50% of the time, the breakouts are smooth as butter. They take off and just run to hit targets. And the other time, we get a little bit more of a battle. Where price will break out and maybe pull back and wiggle around a little bit before we're able to take off. So we have a little bit more of a challenge. Now, I developed a system and a piece of desktop alert software. It's standalone. It does not require any specific platform. You can trade any platform that you have because this is a standalone piece of software. This runs on your desktop, and the system sends out your dynamic trigger range, your high and low, and you'll know the barriers all throughout the day, and then you get what we call proximity alerts. When price gets within a certain distance of one of the ranges, you'll get the first alert, and then when it actually touches, you get a second alert. And then we have various configurations and strategies of how to take the entries when price moves across the barrier in different trading DOM setups, ATM strategies and whatnot to play these moves. You can load this alert software on your desktop and only play a basic 1 minute chart. It's that simple. You don't need any indicators, oscillators, anything like that. The system itself is doing all of the heavy number crunching to create these levels, and then all we focus on is when we get the proximity alerts that price is getting close to one of the levels, we can play the breaks. So basically, you end up with a steady stream of pitches all day long, and you know the exact levels. Our current version of the software, 4.4, we've got the ES, NQ, the CL, and we also, so you've got the dynamic trigger range that you get to work with all day long, and that constantly shifts. You've got some other stuff like a meter and a trend direction and the average volume, which we show you how to interpret this. And then you get dynamic targets and a system trailing stop. There's a system notes section where trade notes go through as well. All right, so basically you have a complete little E-mini trading system on your desktop. It's platform independent. And very quickly, because I got about 2 minutes, this gives you an idea. Now, keep in mind that the levels are barriers. They're important levels in the market where the participants are going to kind of run the ball across the level, which means that there's not just one way that you have to play a trade based on those levels. The levels represent where we have higher probabilities where price is going to break out and make our big impulse moves that we can take advantage of. So this is just an example of a traction meter that shows typical trades, the times they went through, the amount of negative drawdown that was incurred before the positive traction occurred, and then a discretionary trader could get in and trade this in different ways. So if you want a fully automated little E-mini trading system, alerts that get sent right to your desktop, check us out over at poweremini.com. We have a website. I'll just show you real briefly. You can pop over, and if you want to read some real interesting articles, you can pop over to our blog post where I've got all kinds of articles about E-mini day trading that will tickle your fancy and give you all kinds of cool ideas and basically show you how we approach day trading the futures market every day. That's what I got for you, and we'll go from there.
All right, let's do one question here.
Sure.
And we'll wrap up. Does your desktop app work in all markets, all time frames? Is it back tested?
Yeah, here's the thing. I'll just make this real brief. The version that we have in the presentation here, the 4.4, covers 3 symbols. We've got a new version that's hitting like imminently, like next week, basically 4.5, and it's going to have the ES, the NQ, the YM, the CL, and the DAX. The system runs basically 24/6. It only comes down for maintenance, that type of thing. So you can watch during the night session, you can watch pre-market, and we've got multiple strategies. So yeah, everything's back tested when it comes to the development and all that. And as I mentioned, the barriers are the barriers, and as individual traders, we can attack and play those barriers in lots of different ways, which we totally document different strategies, scalping strategies, strategies to hold throughout the day. So We make it very reasonable to get on board, very low price to just jump on board and spend a month. And the best way, without having to try to approve this, that, and the other thing with a million kinds of stats, is to come in and expose yourself to the alerts and just see how they play out for you on sim. And if you see real positive probabilities in your favor, most people will go ahead and stick around. And again, with a very low, reasonable rate, you can check it out over on our website there, poweremini.com.